In this video, we'll be doing an example to understand financial and operating leverage.
Now let us understand the operating leverage and financial leverage through an example. Now if you look at this Excel sheet, now there is a company whose sale is 1 lakh units and the selling price is 2 rupees. So the total amount of sale will be 2 lakhs. Now assuming that the variable cost is 75 paisa per unit, then the variable cost will be 75,000. Now the contribution will be 1,25,000, which is 2 lakh minus 75,000. That means sales minus the variable cost will give you contribution. So the contribution here is 1,25,000. Now assume that the fixed cost of the company is 1 lakh, then the operating profit or earning before interest and tax would be 25,000. That is the contribution minus fixed cost. Then the interest has been calculated as 5,625. Now let us see how this interest has been calculated. Assume if you look at the right hand side of the Excel sheet, the capital structure of the company is given. Company has financed its operations through equity and debt. So there are 2,000 shares companies has issued at a face value of 10. So the total amount collected from equity shareholders is rupees 20,000. And company has taken a loan from a bank at the rate of 11.25%. So the debt is 50,000 and the total capital of the company is 70,000. Now coming back to the income statement of this company, so the interest has been calculated as 5,625, which is based on 11.25% of 50,000. So that means the earning before tax now will be 19,375, which is 25,000 minus 5,625, which is your operating profit, the operating profit minus the interest. So now the company has to pay 30% tax, and company is under a bracket of 30% tax. So the 30% of 19,375 comes to 5,812 rupee 50 paisa. So the profit after tax would now be 13,562 rupees 50 paisa. Now if you have to calculate the earning per share of the company, then we will take PAT and divide by the total number of equity shares, which is 2,000. So it will give you an EPS of 6.78. So that means the earning per share is rupees 6.78. Now let's understand the impact of financial leverage and operating leverage. Now here I have again we look at the Excel sheet. I have taken now the sales I have assumed the sales have gone up by 10%. Now let us look at the Excel sheet again. Here what I have assumed is that the sales of the company has gone up by 10%. So number of units sold will go up from 1 lakh to 1,10,000. So the total sales will go to 2,20,000. So there is a 10% increase in the sales. Now the variable cost, since it is 75 paisa per unit, so the total variable cost will be 82,500. The contribution will be sales minus variable cost, so that will be 1,37,500. Now the fixed cost remains the same, that is 1 lakh. So the earning before interest and tax goes up to 37,500. So now if you look at the EBIT, it has gone up by 50%. Though the sales or revenue of the company has gone up by 10%, but the operating profit of the company has gone up by 50%. Now why it has happened? Because it has happened because of the operating leverage. Now how do we calculate the operating leverage? The formula is given below. Operating leverage is contribution divided by EBIT. So here the contribution is 1,25,000 divided by EBIT, which is 25,000. So which gives you a figure of 5, which means that if there is an increase of 1% in revenue, then there will be a 5% increase in the operating profit of the company. So as we can clearly see that the revenue has gone up by 10%, whereas the operating profit has jumped by 50%. And that is due to the presence of operating leverage. Now further, the interest will remain the same, that is 5,625, and earning before tax will now be 31,875. which is 37,500 minus interest. So the tax will be again recalculated at 30%, so which comes to 9,562 rupees 50 paisa. So the PAT will now come to 22,312 rupee 50 paisa, which is the earning before tax minus tax. So it comes to 22,312 rupee 50 paisa. Now we will calculate the earning per share, which is 22,312 rupee 50 paisa divided by the number of shares, which is 2,000. So the revised earning per share will come to 11 rupees 16 paisa. Now if you look at on the right hand side, both PAT as well as earning per share has gone up by 65%. So there is an increase of 10% in sales, which has led to a 65% impact on the bottom line. Now this is because of the financial leverage and the operating leverage put together. Now how do we calculate the financial leverage, which is the formula is EBIT divided by EBT. The EBIT is 25,000 divided by EBT. So EBT is 19,375. So if you divide that, we get a figure of 1.29. So that means if there is a 1% increase in revenue, there will be 1.29% increase in the profits of the company, that is profit after tax. So now we see that there is a 65% increase in the profits, so which is the impact of a combined leverage. So combined leverage is 6.5, which has been calculated by using the formula contribution divided by EBT. So which means that if there is a 1% increase in revenue, there will be 6.5% increase in the bottom line. So here your income has gone up by 10%, the profits have gone up by 65%, and the earning per share has now gone up to 11.16 from a figure of 6.78. So that explains the impact of financial leverage and operating leverage. So this is the positive impact of the financial leverage. Now let us look at the Excel sheet again. Now it will explain the negative impact of both financial and as well as operating leverage. Now here I have assumed that the sales of the company has dropped by 10%. So the sale number has gone up from, that means earlier the company was selling 1 lakh unit, now they are selling only 90,000 units. So the sale will go down to 1,80,000 from a figure of 2 lakh. So there's a 10% decline in sales. So there will be also a 10% decline in contribution. And then we look at the operational profit, that is EBIT. It has gone down by 50%. This is due to the fact that the company is highly leveraged in terms of operating leverage. So the impact is that if there is a decline of 10% in sales, it will lead to a 50% decline in the operating profit of the company. And if we go further down and see that even the PAT or the earning per share has also gone down by 65%. So because since the combined leverage is 6.5, the sales go down by 10%. That means the bottom line will go down by 65%. So that is the negative side of the leverage. Both operating leverage as well as financial leverage has led the company to suffer a loss of 65% on account of just decline in 10% in sales. Hope you all enjoyed the lecture as much as I did presenting for you. Do add your comments, as it is very encouraging and motivating. Please do like and do subscribe. Thank you.